Welcome to the More Profit, Less Stress podcast. And today we're going to be talking about the 5 most common misunderstandings that business owners make that's destroying their profitability.
No kidding. And number one by far and away, has to be, I mean, you and I talk about this all the time. We see this is pricing. Just priced wrong. It's insane. I was just talking to somebody and I said, how do you determine your pricing? And their first answer was, oh, we just make sure we price it right. I'm like, okay, well, how do you determine that? And he said, oh, well, we look at our competition. I'm like, okay, well, how does the competition determine that? They're like, I don't know. They probably look at their competition. I'm like, great. It's the blind leading the blind.
Well, and you see that all the time because, I think the most common thing customers assume they're doing is phoning around. And if I phone around, I want to make sure I'm within range of what my competitors are doing. And I think the other challenge is that they're arbitrarily being told what to do by people who've got no idea or understanding of their industry. Anyway, I hear all the time, well, I was told I had a 30% markup to my parts. Well, why 30% markup? And do you know what the margin is on a 30% markup? And then it becomes this massive misunderstanding between even just what a markup is, what a margin is, to the point where you don't even know you're pricing yourself wrong or why you're pricing yourself wrong. So then the answer becomes, I guess I better go sell more because it's not priced correctly. And I think you'll agree with this. What we find most times is even if people are remotely close to pricing correctly, they're almost always pricing to cover expenses, but they're never pricing to cover an owner's wage or the net profit that they want at the end of the day. So yeah, you may have priced to cover your expenses, but you've missed the 2 key aspects that actually make your business carry over into a direction that gets money in your bank account and doesn't just keep pulling from it all the time. I'm Dennis.
And I'm Greg.
And this is the More Profit, Less Stress podcast,
where we provide the tools for more profit and less stress in your business now so you can turn into a valuable asset later. Do you know off the top of your head a 30 markup what the margin is? Do you happen to know?
A 34% markup is about a 24.5% margin.
Okay. So to your point, I think so many businesses, they price thinking, okay, number one, I got to cover my cost of goods, right? Like whatever material they have in that product or service. And that's great. But if it's a business that sells like a widget, like a shoe or a whatever, sure, they price to sell the shoe they're buying. And then some expenses, and I think your point is they never really understand, like they calculate what expenses, like how many expenses do I got to cover? And let's pretend they guess, 20%. Then they go do a 20% mark up, which actually is not the margin. So to your point of 34 markup is a 24.5 margin, expenses are a percentage of revenue. Expenses are not a percentage of cost of goods. So if they buy a shoe from a vendor and they go to sell that shoe and they're thinking their expenses, let's say their accountant said, oh, your expenses are, 30% of your revenue. So then they go do a 30% markup to cover that, or a 35% markup because, I'm making 5%. Well, they just did a 25% margin and their expenses are already 30% of revenue. So it didn't work. They didn't allow for any kind of profit. And then many of them don't actually count labor in their cost of goods. If they're say like we have a lot of service clients, right?
Most of our clients are service-based. Yeah.
Yeah. And honestly, in 16 years of doing this, I apologize if I've missed somebody, but I don't think I can think of any client where we started and they counted their service labor hours in their cost of goods. They always have it in their expenses. So,
but they do that for their defense. And why I think it's a massive misunderstanding is because they're reading it from their profit and loss. And their accountant is doing this for taxes. So if I'm running a profit and loss for taxes, I'm just going to put all payroll together because it's just an expense number to find out how much tax you owe. It's not an operational number to find out, am I actually pricing properly to begin with? So to your point, I'll grab a piece of material and I might put a markup on that piece of material or that shoe or whatever it happens to be. But if I'm not properly allocating the labor to bring that to market as either I'm selling it back to somebody, or even if I can't because it has to be in payroll as far as hourly overhead, am I even pricing that properly to know that that person's covered? Or am I just winging it and assuming I just got to sell enough, and if I sell enough, I'll make that number at the bottom?
Yeah, exactly. Yeah, this is by far the number one mistake they make. And I think you're right. They look at their P&L and labor's all lumped together in expenses. And if we were to back up to clarify why we think this is so important, in business, really you're purchasing a thing and then you're selling it. And the difference in that price is your gross margin. And that gross margin needs to be greater than your operating expenses. So if I buy something and sell it to my customer, when I take the selling price, I subtract what I purchased for it, cost of goods, the difference is the margin. And that margin has to be greater than the operating expenses to make a profit. So that's actually the number one reason why, because you and I know business owners, accountants, bookkeepers fight us on this all the time. Oh, Dennis, Greg, just put the cost of goods, labor in expenses. It's all the same at the end of the day anyway. It's an expense. It's an accounts payable. No, because so if business truly is I buy something, whether it's a material or a labor hour, and I sell it, the difference in that has to be greater than my operating expenses to make money. The truest thing ever said in business. That's probably the single most important rule. So an easy way to explain it and how we can justify it is to say, if you buy, if you're a labor company, if you're a contractor or something, and you pay a subcontractor to do something, you would treat that just like a material. So I buy 2x4s, but I also buy the electrical subcontractor to do that work. And then I buy that subcontract invoice from the electrical company and I sell it to my customer. It's the same thing if those people work for me. If they're providing that service, I'm buying those hours from those people. I got to sell them. So to your point, rearranging the P&L in that way allows you to determine on every single thing you do, what's the gross margin percent I have to make so I'm profitable. Huge. It's single number one, by far and away, single number one mistake business owners make that they just don't even realize they're making. Like people talk about common mistakes and they might say, oh, you're hiring. And yeah, that's an important thing, who you hire. But if you're not priced right, like just think about this. If you're not priced right, it doesn't matter who's working for you, how good they are. It doesn't matter how good your location is. It doesn't matter how much revenue you're doing. Like none of that matters. How good your marketing is, your sales are, none of that matters if you're priced wrong. It's all gone. So by far number one. Yeah, 100% agree.
So one of the examples I usually give to clients when I'm having this conversation for the very first time is I'll pick up something off my desk like a pen. So you take this pen, I picked it up at SEMA one year. It was a lot of fun to be there. But let's say I bought this pen for $1. And I take that pen, I want to take it to the market. So my accountant tells me, well, you should mark it up 10%, or my friends, whatever else, tell me I should mark it up for 10% and sell it with a 10% markup. Well, what's a 10% markup on $1?
9 margin cents. Or something? Yeah.
$1.10 for this pen. So I say to Greg, hey, Greg, I want you to buy this pen for me for $1.10. And you look at me and you tear a strip out of me and you scream up and down at me because that pen is way too expensive. And how dare I? And I do all of the negative things we think is going to happen when we give somebody a price. And so I back up and I panic a little bit and I say, okay, no problem. How about for you, I take 10% off. Now, the question I always ask people is, did you make money, lose money, or break even? Now, before you answer the question, here's the most common answers I get. Well, I lost money. I'll say, well, why? Well, because it took time to get me to market. I got to pay my overhead. And I just tell them, stop, pump the brakes. Don't worry about the secondary stuff. I'm asking you to just do the math. If I bought this for $1.10 and I take 10% off, did I make money, lose money, or break even? Now, before you answer, I want everybody listening to this just to think about that for a second. I took 10% off the sale price. Did I make money, lose money, or break even? Well, if I do a 10% discount on $1.10, it's 11 cents. That means I lost money. I lost a cent because now that I bought it for $1, but now I'm selling it for 99 cents. Now I always ask, well, why the difference? Well, because when you're calculating margin, you're always calculating margin off the top price and you're coming down. But when I'm adding markup, I'm always taking markup to the bottom price and I'm adding up, and the two are never the same thing. So even if you're going out there and you're adding in a 34% markup, you have to understand you're still only hitting a 25% margin. If you get this wrong, not only are you leaving thousands of dollars on the table, but you're actually putting yourself in a very fast path to bankruptcy. Because no matter how much you sell, if you're not selling it for the right margin, You're going to be backwards and not even know why. And now you're playing the game of, I don't get to see my kids on the weekend. I'm never going camping. I'm missing birthdays. I can't play on sports teams. I can't do all the stuff I want to do because I got to go sell more stuff because I got to make more money.
Yeah, 100%. So to insert some data into what you just said, most businesses are probably like, if they have rent, like they're renting a space, most businesses are probably around 10% rent. If they're doing really good, their rent might be 5%, depending on what kind of business, where they're located, if it's industrial versus popular street or whatever it happens to be. So let's just say rent's 5 to 10% if you're doing well. Lots of companies are 15 to 20% rent and I mean, then they're sunk right out of the gate, which is another reason we'll talk about today. Wages is the second one.
Actually, that leads us right into mistake number 2. So if
we'll come back to mistake number 2. Yeah, we'll come back to that though. So second thing is wages. You know, most companies are probably running around 5 or 10% wages if they're profitable, if they're doing well. And that's administrative wages, unlike what we clarified a few minutes ago, which is it's not cost of goods wages, right? That's different. So just admin wages are 5 to 10%, rent's 5 to 10%. Marketing, you know, on the high side, probably you should be paying 5%. That could be all that right there. It could be 20, 25% of your revenue just with 3 things. So if that doesn't include any other expenses. So if your margin's not there, you're toast. Totally agree. So back to your other point, leads us into segue 2 or mistake number 2, a bad lease. How often do you see that? You start with a client and they got some kind of bad lease or bad contract of some kind, like maybe even a franchise deal or a bad deal with a vendor or a bad deal with a customer or whatever, just a bad contract in general.
First thing I always say to clients is to remember any contract you're asked to sign is generally never in your favor. So are you actually spending time to review the thing that you're signing? And when it comes to a lease, they're generally asking you for things like personal guarantees, meaning if you don't pay me my lease payment, you owe me your house. And I don't know if people actually fully realize what that means when they enter into it. They're usually just pretty excited about the fact that now I have a place to hang my shingle. Now I feel legitimate. I need more space. Whatever their argument is, they sign that piece of paper with a lot of excitement, not understanding what's all involved when they're getting into that contract, let alone what types of lease they may be entering into.
And then they'll go borrow more money because it's like, oh, we can change the floors and put that really cool chandelier in and repaint the walls and put this big fancy sign up and, you know, these new walls because we want to have this many offices, not that many offices. And we need new desks because everybody wants to be comfortable and new computers because we want to be high tech. And it all starts to add up. They'll sign a lease that if they crunch the numbers properly, they would probably discover they couldn't afford. B, they'll end up spending a bunch of money once they take possession. And then C, to your point, yeah, and then they'll sign personal guarantees. And then most of the leases today, they're being asked to do triple net leases, which is if something goes wrong in the building, they're responsible to pay for it. Like an air conditioning unit, a heating unit, the plumbing, any of that goes, they're going to ask the tenant to pay for it. So the tenant, like if you don't know what you're signing, it's a kiss of death. And I think you and I talk about this all the time, but a big reason the lease is such a killer is because once it's signed, you can't get out. It's a contract. Versus if you hire a bad employee, you can get rid of that employee. You can fix that mistake. If you bring the wrong product in, you can change that product and sell better product. If you price your product wrong, which we said was mistake number 1, you can fix that tomorrow. If you run a bad ad, you can change it and fix it. If you ever order stuff too late, if you order stuff too early, if you pay a bill too late, all that can be fixed the next day. You can change all those things, but you can't change a lease or a contract once it's signed. I remember, I mean, here's just a great example. We had a client, we started, they provided a service, well, a training company, right? They did personal training, and they started in their basement, and we grew the business in the basement, and the business plan was to grow it to a point where 10% of their revenue, which would be allocated as rent, became enough to go sign a temporary lease somewhere. Okay, great. So we do that for about 6 months, and we get it to a point where, hey, there's enough, 10% of revenue is now enough to get a temporary lease. So then they start shopping around for a temporary lease, find a temporary lease, and they sign a month-to-month lease. So they get in there for 10% of revenue as the rent. Perfect. So super profitable, do really well. And the business plan was wait until we hit the revenue high enough that 10% of that can afford a permanent lease somewhere. So we're doing that, and the revenue isn't quite there yet. And they got advice from their banker, of all people, their commercial banker that held their account, that handled their account, said, hey, you guys are doing really well. You should go look for your permanent lease. They went and did that without letting me know or ask me. And they signed a lease that was $22,000 a month. So imagine if you're a gym and your rent's got to be 10%. At $22,000 a month, you need $220,000 a month in revenue. There's not a lot of gyms that can do that.
Yeah, and
and it takes time to get there.
That's a really impossible number to hit.
And this wasn't a big gym. This is a smaller gym. So they just didn't have near the customers to be able to afford that. So they were all excited they did that. And then I found out a week after they signed the lease. And I'm like, as fast as humanly possible, you need to go get that reversed. You need to get out of it. And they couldn't get out of it. And fast forward, we tried all sorts of different stuff, increase the amount of customers, tried to sublease space, but it led to their demise. That one silly mistake ruined a really profitable business. So yeah, signing a bad lease, horrible. Or for that matter, any other contract, right? Like I know you've had clients in the past that were, I think, franchisees that signed a bad contract and inevitably just could never make money under that contract.
Well, and I think the problem is most people walk into it with ignorance, right? You walk into this completely trusting that the other person has your back, right? Or you'll review it with the lawyer, and your lawyer will be like, yeah, it's just a standardized lease contract. There doesn't seem to be anything in here that's a red flag, but it might not be a red flag from a legal standpoint, but it's not necessarily a green flag from a business standpoint. Like I've had clients who've gone out and we've run their numbers and they're doing really well. And one guy went out and signed a lease on a space simply because for him, it made him feel like he was a legitimate business owner, no longer being in his house. He could now have a space to be in. Well, when we got down to discussing it, clients never came to his business. He didn't need to have a storefront for any purpose or reason. For him, it was more of a separation. But when I ran the numbers and what he was paying on his lease, and at that time it was close to $4,000 a month. I'm like, do you understand that this $4,000 a month that you signed in, that you committed to for the next 5 years, is all of the vacations and stuff you wanted to take with your family?
Yeah,
it's all of that free
$48,000 a year
for. Like that's $48,000 to feel emotionally like a legitimate business owner, and that was before we calculated all the improvements he wanted to make to the building. Now, some people will argue, I'm going to make these improvements. I'm going to add these things to this building because I will get a discount on my lease for a period of time, depending on the volume of improvements that I make. That can be true. That's going to be completely subject to the landlord of what they believe whether or not this is an improvement that will add to their leasability to the next person or not. If it's something that's just for you and your business, they may not even agree that that's considered to be a lease improvement. So you want to make sure that you're carefully evaluating everything that you're doing when you're going into that, or you will completely destroy your goals and destroy your business if you're not walking into it smart. Now, there are strategies for setting up leases properly. We get that way more intimately with our clients because it's always a case-by-case basis. And there are certain ways to get out of things, but if it ever gets to court, you're liable for what's on the paper, not for how you feel about it.
Yeah, so leases, number 2, big one. And number 3, and Dennis, I'll segue this into you because you brought it up and it's a good one, is relying on your accountant or bookkeeper. In other words, let me rephrase it because I hear this all the time. Hey, how's your margins, or how's your rent as a percentage of revenue, or how's your profit percent, or how's your wages as a percent of revenue, or any question like that around numbers. And the person says, I don't know, better go ask my bookkeeper or accountant.
Go ask my CFO.
Yeah. Big red flag.
They know the numbers, I don't. Here's why it's a big red flag. As an owner, how do you make decisions for the company effectively if you don't know how each decision impacts you financially? If you don't understand where the numbers go or why they go there, you're completely cut off at the knees for any decision that you make on whether it's going to be a good or a bad one. I've seen this twice. I don't know if you've ever seen this. There's a lot of people that they'll give all full permission to the financials, to the books, to a bookkeeper. And they'll assume things about the bookkeeper, that they're honest, that they're doing everything properly. And 99% of them are. Most people are doing things with integrity. Twice I've encountered it now where that hasn't been the case. They will abdicate the bookkeeping to a bookkeeper, and suddenly the numbers aren't making any sense. In fact, what always throws the flag for me is when I'm working with a brand new client and it's taking us months to get the numbers together, because it doesn't take months, it takes weeks. So why is it taking months? And it's always an excuse from the bookkeeper. It's always, I don't have this, I don't have that. And by the time we finally dig into it, you find out that the bookkeeper is actually embezzling from the company. And they're trying to hide things in different expenses because nobody looks at the numbers anyway or understands why the business is running the way that it is, because nobody's diving in. So if you're not looking at your numbers and understand them, you're not protecting yourself from theft. And yes, it's a criminal offense. And yes, somebody can get arrested, but you can't recover the lost capital. Like, it's super hard to do it. I had one client that basically went bankrupt because of it. So one, you got to know your numbers so you know what's going on. Number two, and I stress this all the time, your accountant's first job and responsibility is your taxes. They're not always focused on your operations. They're wanting to make sure that you're paying the amount of tax you're legally obligated to pay. That's their job. And how a tax form is filled out is different than operational understanding most of the time, because we're not setting up our software to calculate for operations. We're only calculating it for taxes, which means if it's deductible, it's generally mixed in with everything else that's deductible. And all they care about is that a positive or negative on that bottom line, and do you or do you not owe taxes? I can't make.
In other words, they have accounts receivable and accounts payable, and that's it. Accounts receivable minus accounts payable is the difference. Yeah, for taxes. Yeah, totally.
Do I owe any money or not owe any money? And so when we break it down with clients, it comes down to, well, here's the other challenge too with accounting software, because this is leading into what we do with clients. Number one, they consider all revenue to be treated equal. So if I'm selling a SKU of different things, I could be a plumbing company. One, I could be selling a service. The service is I sell my plumbers out to go do the work. Two, I could be selling parts in that service. I could be selling multiple services, things like I might be doing aeration systems. I might be doing fire alarm security systems. I might be doing residential plumbing. I might be doing commercial plumbing. I might be doing new builds. These are all areas that potentially have different margin. Or I could be retailing product out of my store. Well, if all revenue is thrown into my income statement as the same, how do I know what's making me money and what's costing me money?
Yeah.
I've got no way to pull those numbers out.
Yeah, 100%. I totally agree.
I think you guys called it SKUs, right?
Yeah, and we would have departments, then sub-departments, then within sub-departments you have brands, then within that you got SKUs. If you're using your accounting software for all of that, you need all those departments and sub-departments in your accounting software, so that, to Dennis's point, you can measure your margins on each one, because the blend of those margins has to be greater than your operating expenses to make a profit, or you're dead in the water. Now, if you're a little more advanced, you can then purchase a software, subscribe to a software where you can do inventory management, point of sale, all that stuff. Then you can set up all those categories, departments, SKUs, brands, vendors, all that stuff, customers. Have all that set up, have your proper cost of goods, your proper revenue go in there. Then you can see your proper margins by any way you want to dissect it. Great. And then you can summarize that and put that in as one number into your accounting software. No problem. But if your accounting software is your only way to measure it and it's not broken out like that, then you have, to Dennis's point, you have no idea. You have no idea where you're profitable. It's crazy. And then you're just running blind. Yeah. Dennis said it well. Your accountant's job is taxes. What they're not trained to do is make business operational decisions. And that's where your numbers got to be laid out so you can make business operational decisions. You can know, are my wages too high? Is my rent too high? Which of those departments should I be selling more or less of to get my margin up? Is my marketing too high? Lots of times businesses will get wooed into big marketing plans, and that, without realizing, that marketing plan might be costing them, 15-20% of their revenue. And there are very few companies on the planet that can get away with 20% of their revenue going to marketing. Very few. That's very select industries. But the vast majority, if your marketing's more than 5%, probably you're not making a profit. Like if your marketing's 10% of revenue, you're probably not making a profit unless your margins are super high. So very slippery slope if you don't know those numbers. And yeah.
And that's one of the reasons we have two very distinct tools that we've made for our clients. Number one is they're able to actually track return on investment by marketing activity to know that their percentages are where they need to be for their particular business. Now, I'm not going to say there's a certain number for every business because it's not true. There are different businesses that have got different ratios. And so I call it the magic number. What is your magic number for your business that you need to hit for your marketing to make the most sense for you? It's also the same thing we do when we come to operational numbers. We spent 14 years developing a tool that is insanely powerful that allows you to see how every division is doing, how every sales avenue is doing, to know what your margins are on everything, to know exactly how to cover your expenses, to know what's going on. Now, a lot of our clients still have their bookkeepers fill out this information for them, but they have it in a way that's readable and understandable so they don't make the mistake of having to trust their tax numbers for making operational decisions.
And a big one is you got to labor. You got to understand what labor is expenses, like operating expenses, and what labor is cost of goods, and being able to separate those. Because back to our earlier point today, you buy labor from certain labor types. You buy as a cost of goods, sell to your customer, and you have to know what margin to charge on those. And if you got lumped into your operating expenses, dead in the water.
Which actually leads us into our next point, which is the other mistake that people make is not laying out their financials properly and misunderstanding how to read them in the right order. So when we talk about it, like you take a look at, Greg, you've seen this too, when we look at clients with profit and losses, it's usually there's a number at the top and that number's a number. It doesn't matter what the number is. And then you look at the rest of the P&L and it goes blah, 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 positive or negative at the bottom. And then we spend probably the next session or two helping them understand how to rip that thing apart properly. So that way the expenses and the cost of goods are properly separated in a way that they understand it better.
Yeah, you're right. Most P&Ls we look at have revenue and expenses and then profit. And that's pretty much, and this is the blah, 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 blah part. The sad part in there is that many times it's like miscellaneous, general stuff, other stuff. Like there's no detail. Like you don't know what it is. Unknown, like holy crap. So how can you make impactful business operating decisions when it's like general, miscellaneous, other stuff, unknown, like holy crap.
I'll defend the blah, blah, blah for a second because I took the time to fill out a government tax return for my corporation one year. I was very curious to see how this whole thing fills out. And in my particular situation, looking at the breakout of it, they have a lot of things they categorize as the same number for expenses. So as an example, in this particular situation, a management fee and a professional fee were categorized as the exact same thing when it came to the tax return. Well, from an operational perspective, a management fee and a professional fee are actually different things. And then you look at a professional fee and you go, well, what quantifies as a professional fee? Well, I've got my accountant as a professional fee, my bookkeeper is a professional fee, my lawyer.
All outsourced.
Outsource. All of that stuff. Tax-wise, all fits the same category. So it makes sense for me to fill out a profit and loss for taxes by lumping everything in there. But it's really difficult for me to make an operational decision when there's 5, 6, 7, 8, 9 things that are all categorized as the same expense group.
Yeah, totally. And how do you know if marketing's effective if marketing's lumped in with a bunch of other stuff? How do you know if you're spending too much on repairs and maintenance if it's lumped in with other stuff? Yeah. How do you know if people aren't, if office like supplies aren't separated and they're just lumped in with other stuff, then you don't know if maybe people are stealing stuff, right? Like there's so many different ways to look at that. But our big thing, and I know we go into this much more detail in the program, but you got to have revenue, cost of goods. Revenue minus cost of goods gives you gross margins. So that should automatically calculate in your financials. Then you got operating expenses. We like to, and we're not going to go into detail about this today, but when we work with clients, we split those expenses into variable and fixed. And there's many, many reasons for that are super important. And then subtract all that and you got a profit. But then the other question comes up is, where do they put depreciation, amortization, and interest? Some accountants put it in operating expenses. Some put it down here. So then it's actually profit. Then you got, so this is, without getting too technical, this is what they call EBITDA, because it's the profit before depreciation, amortization, interest. So then they put that after. So then you look at this and go, oh, I'm making really good money. But when I deduct the depreciation, amortization, interest, I'm not making money. So let me share an example. Had a client whose accounting firm they outsourced, professional fee, was KPMG. So that's one of the world's most renowned accounting firms. And when we met, the reason they were interested in signing up to work with us was because it was a husband-wife team. The wife ran the business. They were both partners. The husband was a retired lawyer. And the husband said, it just doesn't make sense to me because KPMG's telling me we're making a profit, but it doesn't feel like we are. So we looked at his financials. In the very first meeting, realized KPMG was like, yeah, you're making, like they had him making almost a 12% profit, which is really good, right? 12% is a great profit.
That's
but
really good.
It was 12% before deducting depreciation, amortization, and interest. Well, this was an industry where depreciation's huge. They were buying tons of equipment, and the depreciation every year, the equipment would go down in value by a lot every year. And the amount the equipment went down in value turned out to be almost exactly the same amount as what they thought was their profit. So they had profit of close to 12%, but depreciation was 12% of revenue. So at the end of the day, they weren't making any money. And he's like, I knew we weren't making money. So we had to rearrange everything and then make decisions back to the first reason we talked about today. How do you price your product? We had to change how they priced everything so they did make money. And it took that long to go from, they thought they were making 12%, they're really breaking even, change the pricing, and within 30 days, we got it to a point where they're making 15% as a company. And it goes back to the point we're talking about. So this fourth reason of how are your financials laid out? And are they out in a way you can make good decisions? Because if they're not, like you're literally driving with blinders on if your financials aren't laid out properly. And we see this all the time.
So the way to lay them out properly, and the way we lay them out through our tools, is number one, revenue, yes. But it's not just revenue. It's revenue by departments. Do I know what each department's doing for revenue? The second thing I look at is my cost of goods, and I tie them to the same departments. And some challenges with accounting software is they mix up inventory with actual cost of goods sold, and you got to make sure that's separated too. But it's revenue by department lined up to cost of goods by department. That gives me an impression of how each department is doing. Unfortunately, the one thing that accounting software doesn't do is actually give you percentages for how that makes sense or why that tells a story. Ours does that, so you can see what's going on, because you want to know your numbers plus your percentages. Then after your cost of goods sold, you got to break your expenses into two categories. Number one is always variable expenses. These are things that will fluctuate over time, but they fluctuate off a very specific metric. Then after that is your fixed expenses, and most people are familiar with these. They're the ones that don't change, and one of the key ones in that happens to be your rent or your lease, whatever that number is. You know that no matter what happens, I got to pay that bill. Then finally at the bottom of that, that's where you get that net profit line, and that net profit line on accounting will have depreciation, appreciation, everything else. Our tool breaks that out for you so you can actually see what your EBIT is, what your EBITDA is, and you can find a way to make all of improvements in all of those areas. So if you misunderstand how your financials are laid out, you're never going to be able to make profitable decisions because you're just flying blind.
The last point before we go to reason number 5, the last point to add to this, to what Dennis just said, is, and you can go look this up, there's cash accounting or accrual accounting. And if we were to dumb it down kind of simple, cash accounting means it goes into your P&L when the money's collected or when the money's paid. So for revenue, it would go in your P&L when the customer pays you. For cost of goods and expenses, it would go in your P&L when you pay the bill. The problem with that is you'll never know your gross margin percent in that time period. Like pick a time period, say a month. You'll never know your gross margin percent in that month, which becomes a problem because we're trying to, as a business owner, you want to know that your gross margin percent is greater than your operating expenses to make a profit, period. If you have, let's take an easy example, like say a shoe store. If you sell $100,000 worth of shoes in a month, and let's pretend the shoes, so your revenue is $100,000. Pretend the shoes the shoes you sold cost you $50,000. So then your gross margin's $50,000. If your operating expenses are $40,000, you made $10,000. Good job. However, if you're doing cash accounting, then you'll have $100,000 in sales, but what will go in cost of goods is all the shoes you bought that month, not the shoes you sold. So if you bought a whole bunch, like let's say you bought $150,000 worth of shoes that month for whatever reason, then you'd have revenue of $100,000, cost of goods of $150 because you bought $150,000 worth of shoes that month. You didn't sell them that month, you bought them that month. That leaves you a gross margin -50, and then you got expenses of $40. Now you're losing $90,000. And did you really lose $90,000 that month? No. But now you're panicking, freaking out, and your bank's freaking out, and like, what's going on? And you're making bad decisions. But that wasn't the truth. So you want to use accrual accounting so that the cost of goods is the cost of goods of what you sold that month, not the cost of goods of what you sold some other month. For a product business, that's pretty straightforward. Where it gets really complicated and where we work hard with clients on this is when you're in a service business. How do you make those line up? Because if you do cash accounting in a service business, you might have a project that lasts 3 months. So if you got, cost of goods going in every month when you paid it, revenue coming in every month when the deposits were made or whatever it was, they never line up properly, and you never know you never know what your gross margin percent is, and therefore you'll never know if you're profitable. Here's an easy way to check it on your own. Run your financials and look at your gross margins and see if the number's going up and down like a yo-yo or if the number's pretty consistent. If the number's going up and down like a yo-yo, your bookkeeper or accountant are probably doing cash accounting, and that's a huge no-no for business operating. If your margin's pretty flat or pretty steady, you're probably doing accrual accounting. Now, an accountant or a bookkeeper is going to say, Dennis and Greg are screwed. This is wrong. It doesn't matter, because at the end of the year, it all averages out. Well, that's total BS, because in the first 3 months of the year, you may have revenue that you collected from a customer, but the cost of goods may be in the previous year's fourth quarter. So no, they don't line up. And in the fourth quarter of the year, you may have cost of goods you're paying for where the revenue being collected is in the first quarter of the next year. So there's the first 3 and the last 3 months of every year, those numbers aren't going to line up, which means 6 out of 12 months, they're not lining up, which means it doesn't shake out in the averages at the end of the year. You're not going to get an exact number. You could be off, your margin could be off by 5 to 10%. That could actually be the difference between whether you're profitable or not profitable. And you might, it might show you're profitable by 8%, but in true fact, in a cash accounting scenario, it might show an 8% profit at the end of the year. But in actual fact, you might have lost 2% not even knowing it, because cost of goods and revenues are in the other years before and after. That's crazy. Then you're just going to go another year and not make money again and not know the difference. Or you're going to lose 8% one year and make 7 the next and go, oh, well, now it's good. But no, it's not, because the two together worked out to not making anything. So if you're talk to your bookkeeper or accountant and get it switched to accrual. If all of this sounds very confusing, which by the way it is, it's a very complicated subject. Dennis reminds me of that all the time. This is a complicated subject. But if it's complicated and it doesn't make sense, get help to fix it. Your accountant and bookkeeper are not the people that are going to do that for you. A program like ours will. We have tools that fix this for you, get it set up so you can price profitably and understand right out of the gate. Anything you want to add to that before we go to reason 5?
Yeah, I'd actually say that it's complicated if you're using traditional methods. Our method actually makes it very simple. Right? Like it's a simple way to go about doing it, and it's very simple to understand when you use the right tools to get the information. The challenge is that the vast majority of the tools that are out there are designed for taxes, not operations. Our tool is specifically designed for operations, which is really funny to me because I've got clients that will take our tool, bring a copy of that to their accountant, and then have the accountant do the taxes off of it. So if you have the right tool, it's simple. If you don't have the right tool, it's a heavily complicated subject, and it's going to take you a long time to figure out.
Yeah. And I think the moral of the story is the accountant lays it out to know how much tax you owe. If you're not operating profitably, you're not going to owe tax, which is not a good thing. Like, you want to make money, so you owe tax. Like, I know taxes can kind of be a pain, but at the end of the day, it's a measuring stick to say you're making money. And I guess the last closing comment is, if you're not paying yourself a wage and expenses, and you're just saying, I'm going to take dividends or profit, that's not really a profit. Make sure you're doing, like, if your company's making $150,000 a year and you're like, wow, I'm doing okay, but you paid yourself zero for your wage and the operating expenses or cost of goods, if you're not paying yourself there, then that's not a true profit. You just own a job that's super stressful. So adjust your expenses, even just with a pen, to know how much you should pay yourself for the job you're doing, and then see if you actually have a profit left over. Because most of you are probably going to find out, if you paid yourself a fair market wage for the job you do, you probably don't have a profit left over. So it's a false profit. What were we going to add?
I would adjust that conversation a little bit and say, how you pay yourself as a tax conversation. That's between you and your accountant. How you understand where you're paying yourself operationally is a you conversation. Do you know how your wage fits into the structure of your company? Here's an example. If I am Jimmy and I'm running Jimmy's Plumbing, I am probably doing a bunch of different activities in the business. I am probably a plumber. I am probably an office manager. I am probably an HR guy, and I'm probably a sales guy doing all of these different things. Well, each of those categories will pull a paycheck. How you understand that operationally is different than how your accountant is going to take all of that money and pay you tax-wise. So you need to differentiate between what's an operational wage and what's a tax wage. And the tax wage is the conversation between your accountant. How to understand it operationally requires a tool that shows you how to quickly break it down so you know how to understand your financials. And here's the key reason why. If I'm the plumber and I'm not calculating my wage as a plumber for doing the plumbing work, I can never replace myself, because the person I'm going to hire isn't going to be a plumber for what I'm paying myself. Just straight up. They're not going to do it. So how you pay yourself matters, and where you pay yourself matters. How you pay yourself tax-wise is between you and your accountant.
For sure. So that takes us to the fifth mistake people are making, is operating expenses being too high. And there's a few, like, there are many operating expenses that could be high, but there's only maybe 4 of them that can add up to a lot. One for sure is wages. What wages should be as a percentage of revenue will vary by industry and by company. It all depends on your structure. Like, I know there's a big coaching company out there that promotes, for every employee, you should be doing this much in revenue. That is such bad advice, because you could be and here's just an easy example. You could be a grocery store that is off the beaten path. You got to drive kind of out of town to get to it. And when you get there, they got a big selection. They got, let's say it's a farm to table kind of grocery store. They got a big selection. They got some cool, unique stuff. And when you go in there, they have unique, different types of varieties you've never seen before. So you would like help with that. And they probably need more staff to be able to answer those questions. And, maybe it's a bigger store, so there's a lot of bulk stuff. So maybe they need staff to help you get stuff to your car. However, because they're 30 minutes out of town, they're able to pay really cheap rent. So let's say their rent is 2 or 3% of revenue. They can afford then to have wages be, say, instead of wages being 10% of revenue, like say a normal place, maybe they can pay 15% wages as a percentage of revenue, because they stole 5% from the rent. Where then you go in town to a store like a Whole Foods, premium rent, because they're in a premium location, the rent's way higher. So because the rent's a lot higher, they can't afford to pay as much on wages if they're going to sell at the same price. So the whole thing about, for every staff member needs to be a certain revenue, is just total hogwash. It completely is subjective to situations. But the key is you need to know for your company, what percentage can I afford on wages? And when we say wages, we mean operational wages, not cost of goods wages. That's a big, big deal. I mean, you and I see this a lot with companies. Like when we first meet them, it's one of the first things you look at, right? If they're not making money, boom, you look right at wages. You can see they're too high as a percentage of revenue. And I'm sure you see that. Another one, which we've already talked about, is rent. If rent is too high as a percentage of revenue, you're dead in the water. So wages would be one, rent will be another. Now, wages you can fix. You can fix that tomorrow. Rent, super hard to fix if you already signed a lease. So if you got a lease you're hooked into and your rent's too high as a percentage of revenue, then you got to look at a couple of things. One, can I increase my revenue? What do I got to do that? Two, can I increase my gross margin percent by modifying what I'm selling, the mix, the blend of what I sell? And three, maybe can you sublease some of your space? Like, can you go back to the landlord and say, can I take less space? Or can you sublease to somebody else and they take some space? And can you do as much revenue out of less space? You know, there's a lot of things you got to look at there. That's a tough one. Third one is marketing. As we see a lot of companies, right, where they come in and marketing is 10 or 15% of revenue when we meet. And at the end of the day, they can't afford that.
Or
are they getting the ROI?
They'll also strategically break out how they quantify or qualify marketing. They'll say, well, you need to spend ABC on ad spend, plus you have to pay me XYZ to manage it, plus there are these fees on top. Well, from my perspective, if I'm hiring somebody for it, it all has to fall within that range of acceptable ROI. Otherwise, I'm throwing away a lot of money on marketing that I don't need to throw away. And the other challenge I run into with marketing companies is you have to be very careful to review the contracts and the promises they put you under, because there's quite a few that will find a way to not deliver, and they don't not deliver on purpose. I'm not saying that at all. It's just that marketing is a very complicated subject and it's hard to always know where to land. That's why it's better that you are very on top of your numbers to know what you can spend. So as you find out what's working for you, you know where you can spend more, but you're also not overspending while you test.
Yeah, totally. And then the fourth one under expenses is like a franchise fee or a licensing fee or some kind of some kind of fee you're paying for that. And again, you know, we've seen that where we work with lots of franchisees and it can be great. But sometimes there's a contract in place where the franchisor is just asking for too much based on the model. So if you sign a bad contract with that and your franchise fee is too high, or sometimes they'll do like a franchise fee and then they either call it a brand or a marketing fee. And sometimes that's too high. I've seen, I mean, Dennis, you can share what you've seen with this with clients, but I've seen clients as low as 1 or 1.5%, like branding or marketing fee, above and beyond the royalty, we'll call it. But I had one client where that branding marketing fee was like 7%. Holy crap. Which means like 7% of every revenue dollar they had to give to the franchisor just for marketing. That didn't include the royalty above and beyond that. It's crazy. Like they can't afford it. So another big one to look at.
When you stop to consider the overall structure of a business, you have to look at, number one, what is the average profitability of most businesses across demographics? Like, what is the actual average net? Now, that one can be a little bit fuzzy because, of course, you will structure your business certain ways for tax purposes. It is just what it is. But if you look at the numbers across the board, the average profitability for most companies is around 5%. Net profit, like after everything is said and done, is around 5%. Well, if a franchise fee comes in between 5 and 7, well, you have to be very, very, very closely look at the franchise that you're getting in, because if the standard is 5% and they're asking for 7, you're operating already at a net loss of 2. So is the franchise structure set up enough that you'll never see that loss of 2, because that's already 7% you never get access to. It just comes right off your revenue and goes right out the door, and you've got no way to access or control it. So do your due diligence on a franchise. Make sure you investigate every component of what their company is offering. Make sure that you investigate other franchisees in their section to know how are they actually doing financially. Are you actually breaking out the numbers to know if this is a good move for you or not? There are some franchises out there that are incredibly powerful and profitable to own. I think McDonald's is one of those where you have to have like $1 million in net worth before you can even start. But you're guaranteed to make a lot of money being a McDonald's franchisee because they've dialed in the system so well. The other problem with franchising is, and I've seen this happen, people will have a concept for a business. They'll go, you know what, this is a really brilliant concept for a business. I'm going to go to a franchise lawyer and I'm going to franchise this concept, having never actually executed on the concept themselves. I had a gentleman I reached out to says, hey man, or who reached out to me, we're talking specifically about this. And he said, I'm going to take this, I'm going to go franchise this, and I'm going to go bring in a lot of money. I said, that sounds like a great idea. How did your first 2 or 3 pilot locations go? And he's like, well, what do you mean? I said, well, you've obviously launched this in 2 or 3 different spots with managers and stuff like that to make sure that it can actually make money. He's like, no, it's just a brilliant concept. I'm just going to go franchise it. So be sure that you're entering into a franchise that isn't one of those. That's not just a concept, because now you're committed to giving up a percentage of everything you do that's going to impact your overall net profitability off of somebody else's idea.
Yeah, totally.
There's actually a lot of franchises that are set up, and Greg, you've got experience with this, that require owner operators, meaning the whole system is set up that you actually just have a job and you can never leave it because they don't want you to leave it, because they know if you leave it, the whole thing's going to fail.
Yeah, totally. To expand on what Dennis just said, because that's a really good point. Lots think they have a great concept, they haven't proven it yet, and then they go sell it. And then there's some others where they think they have a great concept. It's never made money corporately, like the locations they've owned or geographic areas. So then they get advice, go franchise it, and then the franchisees will pay you money, you'll make money off it, and then they'll figure out how to make money. And then you end up with a company with a bunch of locations. Franchisors getting their 5, 6, 7, 9%, but the franchisees basically just making, 50 to, if they're lucky, $100,000 a year, but that includes their wage. So really they own a stressful job. They don't really own a business, to Dennis's point. So be so careful with that. Be very careful with that.
Say, like we discussed earlier, a contract you have to sign is almost never in your favor. So make sure you understand the contract completely before you put pen to paper.
Yeah, 100%. So those are 5, what we find from our experience, very common misunderstandings and issues in businesses where people make bad decisions, but they're not commonly talked about. Like, you may say to somebody who owns a business, what's a common problem businesses have? And they might say, oh, hiring and finding the right people. Yeah, is that common? Is it important? You betcha. But today was about talking about 5 that people don't talk about that are super impactful and very, very common.
Thanks for listening to the More Profit, Less Stress podcast. If you liked what you heard, be sure to subscribe or follow on your favorite podcast platform and leave a comment or review if you're feeling generous. To learn more about us and what we do, check out our website. Until next time, take care.